This video is a discussion of example 1 in your foundations reading. The objective of this example is to take a closer look at the relationship between accounting numbers that may appear in a balance sheet and the market values that the corporate financial manager is focused on. At the top of the screen, I have written out the fundamental corporate finance identity. It is absolutely central to pretty much everything that happens in the financial manager's responsibilities, and it's always a good idea to think about things in those terms. Now, accounting numbers are not generally the route by which the market value numbers of assets, equity, and debt are determined. Instead, as we'll see in the next video and further on in the same reading, those things are determined on the basis of projected cash flows, but we don't need to worry about that technicality now. For the moment, we are looking at the proposition of if we are presented with a balance sheet containing obviously accounting numbers, and the arrangement of that balance sheet is reminiscent, looks very much like the arrangement of our corporate finance identity. So up here we have assets, market values. In market value terms, that assets equals equity and debt. And the balance sheet is arranged in much the same way, that it has assets, equity, and although I've written the word debt here, accountants tend to use the word liabilities instead of debt. Now, that relationship looks very close and very useful. Can it be true that we can we take that accounting number that looks very exact and temptingly a tempting proposition for us to assume that, for example, the market value of PPE, being property, plant, and equipment, what used to be called the fixed assets of the company, is the market value of that PPE the same as the accounting number, which is 1,350 million or 1.35 billion for short. And at the bottom of the screen, I'm going to be using a kind of a tier list coloring for answering that question in this central column, the central blank column of what is the answer to the question of does that accounting number represent the market value? And we have a red cross for almost never, an orange question mark for maybe, but under really limited conditions, and a green tick mark for probably. Even there, I'm not saying yes, indeed, it's certain to be the case. There are always conditions here. Let's go through these one by one. Property, plant, and equipment. The answer for that is that the market value is almost never going to be the same as the accounting number. But there are circumstances in which it may well be the case that sometimes that accounting number is the same or close to an approximation of market value, and that is when that property, plant, and equipment has been recently revalued by the company. Now, if accounting is not your field, you may not be aware that companies have the option of either showing their assets at a historical cost, less depreciation, or a revalued amount. But we don't need to worry about that now. For everybody in the class, what you need to know is that only if the PPE has been recently revalued may it be okay for you to presume that market value is the same or a close approximation of the accounting number. Inventories, almost never. And I'm not even going to put a question mark there because it really is only under such limited circumstances that if your inventories have been damaged by, for example, fire or flood, or you have old inventories, which means the same thing as stock, by the way. You may have old stock that people really don't find fashionable anymore, and you then write that down to what is the technical term being net realizable value. And it's only under those very limited circumstances of written down damaged or obsolete goods that you may well have the case of market value being close to the accounting number. So rare, I would suggest that I'm going to leave that as a red cross. Receivables, these are Yeah, problematic. One doesn't want to go too much into the proposition that managers may be cynical and manipulative and playing around with the numbers, but there are demonstrably situations where the accounting rules for receivables are manipulated by company managers to their own benefit. And what is going on here is that there's something called a provision for doubtful debts, which is really a thumbsuck by the managers of which of their customer debts will not be able to be collected. And it is in the nature of that particular number that managers can either inflate or deflate that provision for what they think will not be collected from debts that have gone bad. And it is just such a risky number that I'm just going to leave it as a kind of an unknown situation at this stage. I'm not even sure what I want to write down in this column here. We'll come back to that in a minute. Cash is, that's okay. And yet again, we have to say, look, cash will be the same. The market value of cash is the same as the market number, as the accounting number, if there's no fraud in the company. Let's move on to equity. And equity, once again, and equity is, you don't, if you're not in accounting, that don't worry too much about the split between share capital and retained earnings. Those are accounting divisions. Together they form the equity number, and it is almost never the case that the accounting numbers equal the market values for equity. And I just wrote down there in the blue box, talking about cash shell companies. I don't need you to go deeply into that, or maybe a brand new business. But certainly for your purposes, I believe it would be adequate for you to take away an understanding that equity numbers, as they appear in the balance sheet, are almost definitely not going to be the market values. For debt, at what the accountants call liabilities, the borrowings are, I'm going to go for an orange question mark here. This is one which is probably closest to cash in terms of, it's often the situation that it is okay to assume that borrowings, the accounting number is the same as the market value, but really what you're looking for at this level of your studies is, you say, looking for a question or a situation where there's a reference to floating rate debt, and that would be a signal by the examiner or in the professional context for you to say, aha, I do remember, for whatever technical reason, I don't need to worry about it now if I'm a non-accounting specialist or non-financial specialist, but a floating rate debt number, I can assume that the market value is the same as the accounting number. And the other situation here, and I'll just make clear that that's an or close to maturity. Even if it's a fixed rate, that's the opposite of floating rate, even if it's fixed rate debt, if it is close to maturity, there is an effect in finance that will ensure that that number is pretty close to your market value. Your accounting number and market values are pretty close. Payables, I'm going to revert here in my tier list to a kind of a no, I don't like that much, to maybe a question mark. And payables include, for technical accounting reasons, all sorts of other fancy, weird accounting constructs like provisions and accruals. And often these things don't really have a particular economic reality basis. And therefore, my condition in the blue box is to say that payables are not likely that you are able to assert or assume that market value is the same as the accounting number. But if under fairly obscure conditions there are no provisions or accruals, and in fact the payables number does only include amounts which are owing to your suppliers, to your company, and there's nothing else in there, none of the other accounting funny stuff, then your market value will be the same as the accounting number. And the receivables, just to complete this box, I would say receivables would be, when might the accounting number equal market value? When the provision for bad debts or doubtful debts is reliable. And I'll just leave it at that. And that is example 1.